Welcome to the latest Motley Fool scoreboard. I'm on in Chocobaloo. We've got longtime fools Jason Hall and Matt Frankel giving a 1 to 10 rating to maybe the most fascinating big bank out there due to a major acquisition last year, its history of innovation, and its credit card focus. It's Capital One, ticker symbol COF. First, we'll rate the strength of Capital One's business, including factors like industry and competition. A 10 is invincible. A 1 is hopeless. Jason's at a 7. Matt, you're at a 6.
Yeah, Capital One is a top 10 bank in the United States by asset size, and it is the most credit card focused. They do a really excellent job of blending the low-cost structure of an online bank with things like online savings accounts and things like that, with the service of some in-person branches. The Discover merger, which is what you just alluded to, is especially interesting from a long-term perspective. They're now the only top 10 bank to own a payment network. The reasons for the low score are that the credit card industry is coming under attack right now, as we all know, from not only the Trump administration, but from other politicians as well. The credit card business itself is very cyclical, and there is a lot of competition for credit card business out there.
Yeah, that's exactly right. And the acquisition of Discover, I think it's definitely amplifying some of the risks. It moved it from a little less than half of its loan book was credit cards to now it's closer to 2/3. But the reason I gave it a 7 is I think that even with all of the noise right now, this is not the first time we've heard these sorts of things with the reality of credit card interest rates being very, very high. But I think the other side of their business where they benefit operationally, to me, creates a lot of value. So this is a bank that has a good track record of delivering solid returns while balancing out the risks that are there. And their user interface is wonderful as a customer. I think sometimes we don't appreciate how some of these banks do a better job making it easier for people to do business with them. I think all of those things together make it a little bit higher than what Matt ranked.
Yeah, we all know banks with awful interfaces, so it's a big thing. For management, a 10 is Warren Buffett, a 1 is Homer Simpson. Jason's at an 8. Matt, you're at a 9.
Yeah, it is the largest founder-led bank in the United States. Richard Fairbank, he's done a great job. He's an innovator. I know Anand lives next to some of the Capital One cafes that are like their branches / coffee shops. And then there's the unique credit card products, and there's the acquisitions like the one that they just announced. They're buying a fintech called Brex for a little over $5 billion. It really shows this forward-looking approach, and over the long run, it's really paid off for shareholders.
Yeah, I gave Fairbank an 8, and again, I don't think there's a lot of the other management team you're really ranking on because again, how many banks this size can you even come close to thinking about last time that they had a founder involved with, much less still actually running the business? And it's done well for periods of time. It has not been a market beater since the financial crisis. That's important. But it's absolutely been one of the best performing of like the large regional banks, which arguably it's more than that now. The question though, for me is with Fairbank is the Discover deal, is it going to harm his legacy? Or I think more likely it's really going to set it in stone as one of the great innovative bankers of the 21st century, kind of like Matt was talking about.
For financials, a 10 is a fortress, a 1 is yikes. Both of you have 7s, Matt.
Yeah, this is a highly profitable business. An 8.2 or 8.3 net interest margin, that would make other big banks very jealous. There's very strong capital levels here. Both loans and deposits are growing, even in a challenging consumer environment. It has roughly $454 billion in loans and $476 billion in consumer deposits. That's a really solid ratio. The efficiency ratio is 51.8%, which most banks are around 60, and lower is better. They have an elevated net charge-off ratio, though, that could get a lot worse in a hurry in bad times, which is why I gave it a 7.
Yeah, that ratio you talked about works because it's a credit card bank, and it earns such high yields on the loans that those credit card borrowers are paying, and it pays an above-average yield back to depositors, which is one of the main reasons that I bank with Capital One. My 7, I was tempted to go lower just because it is on the front edge of risk during an economic downturn because of that mix and because it is becoming more and more concentrated. I'm also really focused. I'm not concerned about it, but I'm watching really closely How does it continue to kind of digest Discover and integrate those two businesses together? These big deals like this, very often they don't deliver value for investors. 2026 is going to be another messy year after 2025. And they're really saying that it's 2027 where we should get like a real idea of how this merger is going to fully pay off. That creates a lot of financial risk, especially if we go through a downturn, an economic downturn, because that's the money that they're going to need to continue to do these things. Here's the last one. If you look at their charge-offs, the last results that we got, their charge-offs are now higher than they were in pre-pandemic levels. That's something I'm watching really closely because that indicates there could be some issues on the balance sheet that could get even worse if we do see more economic deterioration.
All right, let's talk valuation, Jason. How well will Capital One stock do over the next 5 years, and how safe is it? 10's a sure thing, 1's a lottery ticket.
Yeah, I think 10 to 15%. The safety score is 6. 6, again, it's a bank. I tend to rate banks lower in safety score because they're heavily leveraged and they're heavily tied to the economy. There's so much happening with Capital One right now. I think that increases the risk. We just talked about it with the acquisition of Discover, integrating those businesses together, and already being on the front edge of the risk pool in terms of their loan book. Look at that with the deterioration we've seen of their default rates. I do think, though, that with that, there is that risk, but I do think that there's a good chance we're going to get good double-digit returns because the valuation is good. And as much as it's going to help them consolidate the credit card industry, it's going to help them on the back end in reducing their expenses too.
Yeah, I also said a 10 to 15%. I gave it a 5 for safety. Capital One, they're set up nicely to outperform with a combination of falling rates potentially boosting consumer confidence and loan demand, the synergies that are supposed to happen from the Discover merger. There is the added risk that comes with the legislative efforts to cap credit card interest. And if a recession comes anytime in the next 5 years, this could be a negative total return stock very easily.
Thank you to Jason and to Matt. They've given Capital One a solid overall score of 7.0 out of 10. For Toppets, Matt prefers American Express because he thinks it's less vulnerable to recessions, and Jason prefers SoFi since it's diversifying while Capital One is concentrating. Look out for a new scoreboard every market day at 7 p.m. Eastern. Next up is General Motors.